Hello and welcome. In this lecture video, we're going to talk about how to do the indirect method. Remember, the indirect method is one of two methods. The other method is the direct method. But these two methods, the indirect and then the direct, are the two different methods that you can use to create the operating activities section of the statement of cash flows. So we're going to focus on this lecture video on the indirect method. Okay, so with the indirect method, as we can see right up here, right over here, we take our net income minus changes to non-cash current assets. Let me back up. We take our net income and we look at adjustments to changes in the account balances of non-cash current assets, changes in the account balances of current liabilities, and then we add back depreciation and other non-cash expenses such as depreciation. Then we look at non-operating gains and losses. So let's begin by looking at our changes in the account balances to non-cash current assets. Okay, changes in the account balances to non-cash current assets. So, in order to do that, we're going to have a couple sheets. The first one is we're going to have our comparative balance sheets. So you can see this one says 2010 right over here. And we have our cash, accounts receivable, merchandise inventory, so on and so forth, our classified balance sheet. Prior year, this year. Prior year, this year. So prior year, we can interpret as saying this is the beginning of the accounting period because it's December 31st, 2010 at 11:59 p.m. You turn the clock 1 minute forward, that becomes January 1st, 2011. So this is ending last year, but we can interpret that as beginning of this year. Okay? Beginning cash, ending cash. Beginning cash, ending cash. Beginning merchandise inventory, ending, beginning prepaid, ending. Okay? We also have that for our current liabilities as well. And then we have our income statement. We have our sales, cost of goods sold, wages, other operating expenses, interest expense, and then depreciation. And then we have our other gains and losses, so on and so forth. Okay? And then we have some additional information, which is something that we'll come back to in more detail when we talk about the investing and financing sections of the statement of cash flows. Okay? The one that I did want to focus on with our operating, though, is this. So I'm going to put O for operating, saying that this deal with operating activities. Okay? And so it says our accounts payable balance, which is a current liability, relates to merchandise inventory purchases. Okay? And that's something that we want to know, especially when we tackle the direct method, which is in a future lecture video, but I just want to go ahead and cue you in. This deals with operating activities, all right? So with step one of the indirect method, what we do is we look at changes to non-cash current assets, okay? And we actually have a rule. And what we do is we say any decrease in a non-cash current asset, that decrease from the beginning balance to the ending balance, that's added to net income. That will be added to net income. Okay? And then on the other hand, if we have an increase in a non-cash current asset, increase in the balance. What this is saying is the increase in the balance. So for example, accounts receivable. Accounts receivable from beginning to ending, that change in the account balance is subtracted from net income. Okay? So why is that? Why is that? Well, let's look at accounts receivable over here to figure out why that is. Okay? So I'm going to go ahead and do a T account. So you can see right over here, I have accounts receivable, 40,000 beginning, accounts receivable, 60,000 ending. Okay? So I have accounts receivable, AR for accounts receivable right there. Okay, so let me catch up here for a second. So you can go ahead. What I want you to do is to go ahead. Well, I'll do it with you. So we have our beginning accounts receivable, 40,000. Put that on the debit side. And we have our ending accounts receivable, 60,000, right over there. Now, what is the journal? I want you to think for a second. What is the journal entry to record a sale on account? Or the other way to think about that, to record a sale on credit. What is the journal entry? And hopefully you remember what we would do is debit accounts receivable, and then we credit sales. Okay? That's what we do. Debit accounts receivable, credit sales. That is our journal entry. Okay? So if I think about that in terms of my T accounts, so I'm going to have a debit to accounts receivable equal to the amount of credit sales that I have. So let's assume that all these sales are on credit. $590,000 in sales. That's what that's telling you. What would be the journal entry if, let's just say, just for sake of argument, that we sold, that our company Genesis had one sale, one transaction, and they sold whatever they sold for $590,000, and they sold it on credit. What would be the journal entry? Debit accounts receivable, $590,000, credit sales, $590,000. Even if this were broken up into 10,000 transactions, right, they would still debit accounts receivable, credit sales, debit accounts receivable, credit sales for sales on account. So what I'm saying is, in terms of the T account, what I can do is I could take that $590,000, which would be my credit to sales, but my corresponding debit would be to accounts receivable. So I can put that corresponding debit right down here in my T account. Okay? I can put that corresponding debit right down here in my T account. So what I want you to do is I want you to take a second and tell me what this number would be. What is the credit? Okay? Pause the lecture video and tell me what the credit would be right there. Okay? Hello and welcome back. So what you should have gotten is $570,000. How did I get that? Well, I can add my $590,000 plus my $40,000 minus my $60,000 gives me $570,000. So that's the credit. Now, just saying that's the credit to accounts receivable doesn't really help us all that much. We have to put that into context. And how do we put that into context? We're basically saying, well, what does the credit to accounts receivable imply? What does that mean? Or we can think of it and say, when do we credit accounts receivable? We credit accounts receivable when we get paid by our customers. Because remember the journal entry to recognize that we get paid by our customers. Let's see. Back over here, we have all of our sales on credit, debit accounts receivable, credit sales. When we get paid, what do? Debit cash, credit accounts receivable. So now, what does this credit to accounts receivable represent? The amount of cash received from sales. That's what that is. So when we look back over here at the indirect method, we can see we have our net income of our $38,900 right over here, and we pull that right here. And then we have our increase in accounts receivable. So we have an increase in accounts receivable. What do I mean by that? Went from 40,000 to 60,000. How much did it increase by? 20,000. Now, if we look at this rule that we have for our non-cash current assets, right? With our non-cash current assets, we say any changes, any increase to a non-cash current asset is subtracted. Why is it subtracted? Well, you have $590,000 in sales. Your net income is based upon $590,000 in sales. But you really collected $20,000 less in cash than you had for sales. So if you are trying to take net income and trying to determine how much cash, right, you have to subtract that $20,000 because you only pulled in $570,000 in cash from your $590,000 in sales. So your $38,000 net income is based upon $590 of sales, but you only collected $570 in cash, $20,000 less cash. So you have to then subtract out that $20,000 difference, which is from 40 to 60. Okay? So the rule again becomes, as we see over here, an increase in the balance of non-cash current assets are subtracted from net income. Increase is subtracted. On the other hand, a decrease would be added. So if we come over here and we have accounts receivable, let's look at that example. Let's say beginning is 40,000 and let's say ending is 20,000, and we still have 590 over here. Take a second and solve for X. Pause the lecture video and solve for X. Okay. So hello and welcome back. So what you should have had was $610,000 cash received, $40,000 beginning, $590,000 of sales, and then $20,000 ending accounts receivable. The balance in accounts receivable decreased. Therefore, it would be added to net income. Why added to net income? Because net income is based on $590, but you collected $610 in cash. So you collected more cash than you had in sales. How is this even possible? It's possible because you collected on the prior period's outstanding accounts receivable. Okay, so in that case, what we would do is, if we're trying to take net income and get to cash, we would add $20,000. So to summarize with the rules for non-cash current assets, which is the first step in the in the indirect method, we look at adjustments to non-cash current assets. Any decrease in the balance is added. Any increase in the balance is subtracted. So then if we look at this, we have to think about what are our other non-cash current assets, okay? Well, up here we have the classified balance sheet, and we can see our total current assets, so it's already divided out for us. Now in the test, I may not give that to you where I've divided it out for you to say, here's the total current assets so you can back in to figure it out. You have to remember what we mean by current assets. Current assets are those assets that we expect to turn into cash within 1 year of the operating cycle, whichever is longer. Examples: accounts receivable, merchandise inventory, supplies, prepaid expenses. Those are examples of current assets. Okay, so you want to look for those and you want to apply that rule that I just talked about. And that rule again: decrease in the balance added, increase in the balance current assets are subtracted. Now again, I'm looking at non-cash current assets, so you don't include cash. Okay, so if you look over here, the indirect method, there's nowhere cash included. We're looking at non-cash, changes in the balance to non-cash current assets. So again, beginning with the indirect method, first step, pull in net income from the income statement, look at changes to our non-cash current assets. In the next lecture video, we're going to talk about changes in the balances to current liabilities. Okay, thank you.